Money Manager. In the studio with me tonight in Cape Town is Abdul Davids, who's a portfolio manager at Kagiso, and we're talking about the Kagiso Equity Alpha Fund. You've been with Kagiso for 6 or 7 years. We've been speaking a lot in the past with the PMI. You're no longer involved with PMI, but of course you're a fund manager. Tell me about this fund. You've been co-managing it with a colleague of yours.
Well, my colleague Gavin Wood is actually the manager of the fund, but the fund leverages of our equity process. So I'm obviously closely involved with our equity selection and equity process as well.
Oh, we're going to get to your top 10 later on, but there's some unusual ones there. I mean, compared to the... I mean, there are some usual ones, but there's a couple of in there that warrant some attention. How do you choose a stock? How do you do it? I mean, is it just you lock yourself in a room, a dark room, and say, look at this valuation, and then work from there?
Not quite. I mean, we've got quite a detailed investment process around stock screening and stock selection. But fundamentally, our philosophy rests on the fact that we believe that there's opportunity for mispricing, and mispricing in the market in general presents opportunity for active managers like ourselves. And so we very much focus on valuations. We've got a team of analysts that will look at the intrinsic drivers of a company and its valuation as well. And based on that, we make an assessment of the value of companies that are listed. And if we see that the share price is significantly different and hopefully lower than our valuation, we would be, given that we buy-side managers, we would focus on buying those companies, yes.
It's interesting you talk about mispricing, because everyone thinks that the market is so efficient. Everyone thinks that with the communications, which we can't escape from, it doesn't matter where we are, even when we're asleep, we're communicating because our phones are pinging. But there are still occasions where people behave irrationally. I mean, the greatest example for me recently was when Old Mutual was below £5 a share. It was 7 or 8 years ago, maybe even longer, but it was being priced for collapse. It was going out of business, and of course that was completely wrong.
That's right.
But so the high frequency trading and the computer trading that tells you to do something is all very well, but on the other hand, it can present opportunities to people like yourself.
That's right, and I think it's marrying that quantitative analysis, which is almost unemotional, which has its advantages, with the very specific and sometimes subjective sort of analysis that we rely on to make that difference. To give an example, I mean, we know that in our current construct, sentiment towards China is very negative, and everything related to China has really been decimated in terms of valuations. We believe that whilst the growth rate in China has obviously slowed, they still have positive growth. And there are certain sectors which should prove resilient despite the weakness that we're seeing out of China. And yet everything is brushed with the same brush, and obviously that sentiment is driving share prices at the moment. Yeah,
it's interesting because I was reading an article by Ambrose EvansPritchard from the Telegraph in the United Kingdom, and he's very, very bearish all the time. It's a right-wing newspaper, a Tory mouthpiece. And he's always looking at the negative. But suddenly he came out yesterday and said that with the housing data that's just come out of China, the mini recession is now over, and you can buy with impunity. I mean, I don't want to get too much on China, but we'll come to that with your exposure to Naspers. But it's going to be volatile. That's all we can guarantee.
That's right, and I think what you want is a business or a company or a stream of cash flows, be it in an asset class or a commodity or whatever, to have a balanced sort of spread. You don't want to be beholden to one driver, like just China, for example. And hence, we've tried to focus and paid careful attention to those companies and even asset classes that are not just single driver dominant in terms of the exposure.
You've been going for 11 years now, and it says here the fund objective is as follows: to provide strong capital growth and a total portfolio return that is in the top quartile for general equity funds. Have you achieved that in 11 years?
In 11 years, we have achieved it. It's been a rocky ride the last couple of years, especially given what has happened in the market, and we can talk about that. But I think, if you look at our track record overall, it's still, we're in the top half, and especially if you look at the existing funds that have been around for the duration that we've been around, we're an excellent company in terms of our long-term track record as well. As I said, the more recent performance has been a bit shaky. Part of the reason for that is that given our valuation approach, what we have done is we've had phenomenal success having significant industrial exposure and very little resources exposure coming out of the global financial crisis. So that 2 to 3 years post the global financial crisis were very strong years for us in terms of performance. In line with our philosophy, as these industrials started to hit our fair values, we started exiting them and switching into the underperforming resources, around about 2011, 2012 in particular. And I think resources in general have been just one of the worst asset classes and worst investments, especially post the global financial crisis. And unfortunately, that has now started to impact our more recent
Well, it's very good that you're very honest about it, but what you're essentially saying is you stuck to your knitting, as they say.
Yeah.
You said this is how we value a share, and if it is too high, then we're going to cut it. If it's too low, then we're going to buy it. Unfortunately, they're getting too higher and too lower, and have been for a while. So you've cut the winners and carried on buying the losers. But of course, your time will come. Let's talk about your asset allocation now, and this illustrates the point you've just made. Basic materials, let's call it 30%.
That's right.
The next one, financials, 16%. Foreign equities, 15% as well. Again, 10% below where you could be. Can we start with that?
Since quarter end, I think we have increased that. We've taken the view that the rand has been quite volatile, so we have repatriated some of our foreign assets. We think that a lot of what is impacting the rand currently is symptomatic of the slowdown in China, the emerging market jitters, etc. At some point, the rand should stabilize and strengthen. The last time we saw the rand at these levels were in 2001.
Yes.
So fundamentally, that presented an opportunity, we think, to just repatriate some capital. I think fundamentally, though, that the opportunity set that we have in foreign equities and selected South African equities gives us a fairly balanced sort of asset allocation sort of view as well.
Okay, let's get into the basic materials side of things. You were brutally honest and said that you got into the resources because of their valuations. They looked cheap a while ago. They look even cheaper today.
That's right.
Some of the shares are completely bombed out. We'll come to one of those later on. But overall, what I'm seeing at the moment in the last few days, Abdul, is a slightly weaker US dollar. And because of the FOMC minutes, maybe interest rates going up is going to be put on hold, or if it's not put on hold, it won't be a regular procession of 25 basis point interest rate rises. So the dollar is weak, and the gold price has really taken off, and the gold shares, having been horrifically undervalued, are doing incredibly well. But all the big ones, like even companies like Glencore and Exxaro, and some of the other big ones, Kumba Iron Ore is a horror story. They're under enormous pressure, but it has a feel of capitulation about it.
Yes, 100%. I think, as I said earlier, one of the key things that we try and avoid is to be excessively exposed to a commodity or an asset class that has one particular driver. And a classic case of that is iron ore. So as we know, China has been the dominant consumer of iron ore for the last number of years. And that has seen the iron ore price going from $35, where it was for decades, to well above 100, etc. So our view was always that iron ore prices needed to retrace, and we felt uncomfortable being exposed to iron ore with such a dominant sort of single buyer. And the reality is that iron ore is different to some of the other commodities, like oil, for example, where oil is consumed and you need to continuously consume oil, for example. Iron ore, once the buildings are built, once the construction has been taken place, that iron ore demand will obviously reduce substantially. So that's the risk that we identified, and we've avoided those commodities, the Kumba iron ores, even to a lesser extent billiton as well. Instead, we focus on those commodities that would benefit and have had exposure to China, but also have a more global sort of appeal as well, like platinum. So European demand in terms of AutoCADs, the jewelry demand, all of those drivers just offset the single China sort of exposure that you had in that metal, for example.
Got to talk about platinum now, and we go to your top 10 holdings, because startlingly, 3% of the fund is Lonmin. And you've been honest in the past. You must have sleepless nights about this one, because it's been relentlessly and mercilessly persecuted by its big shareholders. The other day, 10 times the volume went through, lots of book overs on the JSE, which meant that people said, right, you can have the lot, but we're not going to do it through the market, let's just book it over. So a big change of shareholding ownership, I think.
That's right, and what we have seen with Lonmin is that a lot of that shareholding has actually gone from South Africa to the UK, which is quite interesting. It's come full circle. I mean, Lonmin started out with a significant UK shareholder base. It went to South Africa, now it's reverting back to the UK.
Maybe that's a sign.
I think so. I think foreign investors have been actually quite smart the way they've invested in South Africa. The bulk of the alpha that has been generated over the last couple of years has actually been generated by foreigners. And I think they now tactically, potentially rotating out of those asset classes like industrials and switching into the undervalued resources space. I think one of the other significant developments at Lonmin is they've had the production update since the quarter end. We've had a look at it. There was a point where, I mean, in general, platinum shares in general came down quite significantly, Amplats, Impala as well. So what we did is, post the quarter end, is to actually switch a lot of our Lonmin into to Impala, but to a great extent Amplats as well. Yeah. I think fundamentally, unfortunately, Lonmin has been targeted. In terms of their production update, they say that they are cash flow negative at current prices. And people, you know, they do the sums. That was when platinum prices were just above $1,000. As it went below $1,000, there was indiscriminate selling of the share as well.
That's a good word, indiscriminate. Yes, it was, and it was brutal.
Yeah.
But the price has bounced back now, and hopefully we've seen the low in this thing. I can't believe the platinum went to even below $1,000 now. So we've got a monopoly. You've got Anglo Gold, Anglo Platinum rather. You've also got New Gold Platinum ETF, 4.6%, which is a big holding. So you're putting quite a lot on this platinum price. If it goes wrong, at what point do you say that's it? Electric cars. Jewelry demand, China, commodity route, we have to get out of this. At what point do you do that?
I think what we've tried to do increasingly is we haven't sat back on our laurels and just relied on the market to dictate terms. We've done extensive work in terms of looking at the underlying fundamental drivers of platinum and the PGMs deck in general as well. And we believe that if you look at what is happening in Europe and China in particular, emission control and control of emissions in autocats, all of those things are a reality. And increasingly, those demand drivers will be very positive for platinum. The reality with platinum, as well as with any sort of big mining, is that your planning and your capex, or capital expenditure that you're spending today, will affect your production volumes in 2 or 3 years' time. The reality is, from Amplats to Lonmin, they've all cut capex significantly. That will mean that we will face significant shortages in terms of their production profiles in 2 to 3 years' time. So we foresee a scenario where in 2 or 3 years' time, we actually have a quite significant squeeze on the market. As supply falls off, demand actually coming back strongly with these emission sort of standards in Europe and China in particular. And hence, we've got the ETF exposure. We think that the longer-term outlook for platinum price is actually quite positive as well.
I think you're right. Naspers is 8.5% of the fund. Very quickly, you've only got 30 seconds on this one, Abdul. They've just launched video on demand. Another arrow in their quiver. It's under pressure, and people say it's overvalued. Do you still like it?
I think if we look at, you have to almost look at Naspers separate to Tencent. Tencent is now at current prices over 100% of the value of Naspers. So the reality with Naspers is that they've continuously reinvented the business, and I think the pay TV business 5 years ago was a very different business. They've made it almost bulletproof in terms of the way they've introduced video on demand, box office, etc. And similar things are happening in e-commerce, where they're taking on the likes of Amazon, etc. Yes. And I think that part of the business is significantly undervalued.
Abdul, we'll have to leave it there, but thanks very much for popping in this evening. It's Abdul Davids, Portfolio Manager at Kagiso, and we've been talking about the Kagiso Equity Alpha Fund. That's it for Money Manager.